Hello, everybody, and welcome back to Chapter 2. In this chapter, we'll be looking at the Accounting Information System. Our objectives are looking at the information system, of course, how we summarize accounting transactions, adjusting entries, financial statements from the adjusted trial balance, and prepare our closing entries, and prepare financial statements for a merchandising company. This should be pretty familiar as far as 1A goes, so I will go pretty quickly through this. If there's any problems, of course, you can always join me for tutoring, and we'll go from there. Okay, so we're going to look at computerized accounting systems, manual accounting systems, a little overview and review of debits and credits, the accounting equation, financial statements, the ownership structure, and finally, the 9 to 10 points of the accounting cycle. And lastly, we'll do some recording in the journals and how we post those to the general ledger, what that chart of accounts is, and recording the process. We'll illustrate that as well. And then the trial balance. And the types of adjusting entries. We have deferrals and accruals, and then we go from the unadjusted trial balance to the adjusted trial balance. And we then do our closing entries and our post-closing trial balance, some reversing entries. We will discuss that in a little more depth than we did in 1A, and finally, the summary. Our 4 financial statements will include the income statement, the statement of retained earnings, the balance sheet, and eventually the statement of cash flows, and our closing entries, again, for a merchandising company. So we're going to explain the basic concept of accounting information system here. And here, we're going to collect in that accounting information system the transactions that we process during the month, debits and credits for the most part. We're going to show how we disseminate those financial information to our users of our financial information. And of course, that system may be manual, but mostly you're going to find that they've been computerized. Okay, what are the principles of an efficient and effective accounting information system? Of course, it must be um, cost effective here. We're not going to worry about little immaterial items that don't have any relevance to a financial system, but we want it to be reliable here. We want it to be accurate, and we want it to be relevant. So we want that data to be useful. And if it fulfills those 3 requirements, it will be. So we need to look at making it flexible as well. Here we have technological advances, increased competition, etc., etc. All right, basic terminology here. You're going to find that we will use these throughout the course. These are the same that you learned in 1A or 101, as the case may be. Here we have an event, how we do a transaction, an account, a real account, a nominal account, a ledger, journal entries, posting, trial balance, etc. All right. So debits and credits. First, we have a general ledger account that shows the effect of our debits and credits on a given account. And those are asset, liabilities, equities, revenue, or expense accounts. We create a minimum of 2 entries, a debit and a credit. We may have more than one debit or credit, but the debits and the credits must equal each other. Okay, the account. This is like a little T account over here, as you see. It has the account name here, and the debits are on the left and the credits are on the right. And that's the meaning of debits and credits. Don't think they mean anything other than that. So that's how we're going to depict this general ledger account. Okay, account balances. If the sum of the debit entries are greater than the sum of the credit entries, the account will have a debit balance. Conversely, the same thing if the credit entries are greater than the debit entries. Now, if we look at the balance sheet, the left-hand side, as I call it, are the assets. And a normal balance for an asset account is going to be a debit balance, because a debit makes a left-hand side account get bigger, whereas a credit makes a left-hand side account get smaller. Expense accounts are on the left-hand side as well. Again, debits increase, credits decrease. But on the right-hand side, we have our liabilities and equity accounts as well as our sales revenues accounts. Those are what we sell our products and services. So in this case, it's just the opposite. Debits decrease the right, credits increase the right for all these right-hand side accounts. Okay. Now, in a double entry system, there must be a debit for every credit, and our accounting equation must always stay in balance. Again, in your 1A or 101 class, you learned that assets equal liabilities plus stockholders' equity. So we can expand that accounting equation on the stockholders' equity side and divide it into its components. And we have two components of stockholders' equity. We have common stock here and retained earnings here. Now, retained earnings, to do a statement of retained earnings, very easy. We start with beginning retained earnings. We add net income, and net income is revenues minus cost and expenses, right? Additionally, we subtract dividends. Dividends are not an expense. They're only seen on the balance sheet, not on the income statement. So when we add our net income and subtract dividends to beginning retained earnings, we get ending retained earnings. Just that easy. So the equation will always stay in balance that way. Okay, so here's some quick transactions for the Perez Company. This is review, so I'm going to go very quickly. An owner invests $40,000 here in common stock. So our cash is going to go up, and we've received that cash from the owners, and we've issued stock over here for that $40,000. And if we disperse cash, our asset cash is going to go down. Our stockholders' equity is going to go down because it's an expense. Eventually, that expense will reduce retained earnings. Then we're going to purchase some office equipment. Here that's priced at $5,200. We treat office equipment as a long-term asset, so asset is going to go up, and we purchase that with a promissory note. That's a note payable. So our liability is going to go up. And then here we've received $4,000 cash for services we performed. Cash is going to go up, and stockholders' equity, the revenue from the income statement, is going to go up as well. Okay, if we look at the next transactions, we paid off some short-term liabilities of $7,000. So we paid it off in cash. Cash goes down. Short-term liability, accounts payable, is also going to go down. Under number 6 here, we've declared a cash dividend of $5,000. Cash is going to go a cash dividend. we're going to have our stockholders' equity go down because dividends are part of retained earnings, and our liabilities are going to go up because we've just declared that dividend at this point in time. We have not paid it. So now we're going to convert on number 7, we're going to convert a long-term liability into common stock. Very easy. We're going to make that long-term liability go down by $80,000. We'll make our stockholders' equity, go up. And then at number 8, we're going to pay $16,000 for a delivery van. Both of those are assets. The delivery van itself be a long-term asset, equipment normally. It's going to go up, and our cash to pay for it is going to go down. You can see I'm moving pretty quickly through that. My assumption is that this is sort of review for you at this point in time from your 101 class. Okay, the stockholders, the statement and ownership structure looks like this. The stockholders' equity section of the balance sheet reports that common stock and retained earnings, as I just explained. Next, the income statement reports our revenues and expenses. And retained earnings then is going to zero out that income statement at the end of the month and bring that balance into the balance sheet in net income. And for that matter, it's possible we could have a net loss. And of course, any paid dividends. We're not required to pay dividends if we're a corporation, but if we do, then it's going to be a subtraction from retained earnings. Because dividends, revenues, and expenses are transferred to retained earnings at the end of the period, a change in any one of those 3 items will affect stockholders' equity. Okay, so we prepare our financial statements in a specific order. And the first one we do is the income statement. And that income statement here is revenues less costs and expenses. And one of those expenses may be tax. So what we'll do is we'll subtract that little beauty to those expenses and costs from revenues to get our net income, or in some cases net loss, if the case may be. So net income is an after-tax number. Then we bring that net income, as I explained a second or two ago, into the statement of retained earnings. We add that to beginning retained earnings. We subtract out any dividends, and that gives us our ending retained earnings. That ending retained earnings then goes into the balance sheet here. And so we have stock and retained earnings, plus our assets and liabilities on the balance sheet. So as you can see, we need to do those statements in a specific order. Okay, so if I look at this for the second here, an investment by the owners, that's going to increase stockholders' equity. And you've heard the term permanent accounts. Those are our balance sheet accounts. Another term for that is real accounts. I rarely use that term myself, but balance sheet accounts are permanent accounts, whereas our temporary accounts are also called nominal accounts. All right, so these real accounts, the permanent accounts, are ones that we never zero out. Nominal accounts are the ones we do zero out at the end of the month. So here, revenues increase revenues. You can read these on your own, I think. Expenses incurred are going to decrease owner's equity and will be a nominal account. And then sometimes if we have a owner instead of a corporation, that decrease, when an owner withdraws their money, that will decrease their account, called a drawing account. In a corporation, that's called retained earnings. All right, that looks like a good place for us to stop this video. And when we return, we will continue on. Bye for now.